All right, Rob, we took a little summer vacation from the ROBcast, but now we're back. And I did have a fun time playing a little pickleball with you. Rob, you taught me how to play pickleball July 4th. Had a little bit of an injury, but all those bad things the tennis players say about pickleball, they all seem to be true. But in reality, it was super fun. I had a great time. I did my best so that I can make Logan proud. For those of you who don't know, Logan is our 10-year-old nephew, and he was my partner for my very first pickleball game. Uh, but I ended up sidelined by the whole experience,
But you're back.
which is but I'm back, but which is why I stick with tennis. So I wanted to hop on with you, Rob, because people are talking a lot about rates, and I just kind of wanted you to give us a little primer about what's going on, what we can expect. Are they going to drop in September, etc.?
Okay, perfect. So this one probably won't have as many questions. Will be a little more just a dialogue, Nance. So as you know, what everyone's always worried about in the market is rates, 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 right? And we hear the Feds talk about they're going to lower rates. They're going to lower rates. The reason they're going to lower rates is they believe that inflation is now kind of come. They've kind of got their arms around inflation, and hopefully we can start to see some prices come down. I personally haven't seen that at the grocery store, but hopefully that will, or the gas pumps, but hopefully that will start to, we'll start to see that, which is kind of funny. So as the real estate in the real estate industry, we want some kind of bad economic news because that means that the job market's low, the spending is down, and that in turn is going to help us lower rates. That stuff's a little bit above my pay structure. There's a lot of different factors that go into it, and we're a big country, and so different parts of the country are doing differently at different times. But we wanted to come on here and talk about how does that affect the housing market and your monthly mortgage payment. Um, Rates, I'm sure people have heard, have gone down from their highs. I would say in their back in November and even earlier in 2023, we're looking at highs of 7.5%, north of 7.5%. The last two times the Fed has spoke, they've talked about they're going to start cutting rates, maybe in September, either 25 basis points or 50 basis points, and then maybe again in November.
Just to
Well, how's that
clarify
affect
what a basis point means, it's so if it was 25,
0.25%?
okay.
Yep. And most of that stuff is the Fed borrowing rate. And so then that after that happens, it trickles down to your credit card, to your mortgage rates, to your money that you have in your money market accounts or CDs. So if you've been making that 5% in your CDs in the last 6-7 months, that money is now down. You're going to see that number drop. Okay. Now, what happens to us in our business is when you hear, hey, the Fed's dropped the rate 25 basis, a quarter point today, we immediately get a million calls that said, hey, I want to lower my rate. The Fed's dropped the rate a quarter point. But that's not how it works. And vice versa. When it goes up a quarter, do our rates go up a quarter? No, they're not at all. They're very, very loosely tied together. And what I mean by that is the market is already priced for a 50 basis point cut in at some point in either September, October, a total, maybe 25 points each.
So all lenders right now, the offering that they are offering right now, they have baked in, as they say, baked in a projected rate cut.
Absolutely.
Okay.
Absolutely.
So I'm not going to see whatever the rates are right now, even if that 25, 0.25 or 0.50 cut happens. I'm not going to see necessarily that reflected in the rates in September.
You already saw it. We already saw it.
Okay.
Okay. We already saw it. If the rates were at 7.5 earlier this year, they're at this point now down to about 6.5. Okay. And the Feds had nobody's dropped any rates yet. And so you're saying, well, how'd that happen? Well, because we're already expecting that to happen. That's already been built into the market. What would affect it tremendously is if the Feds go and speak and we think they're going to drop them 50 basis points, and let's say they drop them 75 basis points. Well, then the interest rates, we didn't have that baked in. So then the rates would plummet. Your mortgage rates would drop significantly. And And the opposite side, what if they drop them a quarter and Powell says, you know what, we think a quarter's all we're going to drop them for the rest of the year? Well, that's when it's tough for us because we'll get calls. Hey, the Feds dropped the rate today. Yeah, but they said they're not dropping it anymore. We thought they were going to drop it this time, next time, and the next time. Rates will skyrocket.
Mhm.
So it's what's said. What people want to do is when they're looking at that, don't just read the caption of Feds drop the rates or they're going to drop the rates. Read what they say in the minutes, and we can or talk to your mortgage professional or real estate professional and say, hey, decipher this for me. What did this really mean?
Mm-hmm.
That's the macro big stuff that not as
Yeah,
many
that's
people.
super helpful.
So that's what you hear when you see that going on and you hear that on the news. That gives you an idea of, okay, they're 3 or 4 months out of knowing what's going on with this, expecting, excuse me, not knowing, nobody knows.
Mm-hmm.
It depends what market indicators come in the next readings, jobs report, CPI, stuff like that.
Unemployment. Yeah, I guess that's the jobs report.
Yeah.
Okay.
Okay. So if the rates go down, want me to go with what's that mean for you if you're looking to buy a home?
Yeah.
Right. We put together a little, what do you call it?
You want me to
Slide
share
or
it?
yeah, would you?
Yeah.
Basically, what it means while Nancy's putting this up is it means that the lower the interest rate, the lower your payment. The lower your payment, the more you can borrow. Okay. I know Dave Ramsey's not a huge borrowing fan, but he's a bad word in my industry, or for me anyway. Okay. So what that means is if we look at this screen here and let's look at the loan amount of $750,000.
Okay.
So 6 months ago, if you look to the right of your screen, a $750,000 loan at 7.5%, your payment was $52.44. Okay. Let's say rates dropped to 7%. Now your payment's $49.89. Okay. Now your rates drop to 6%. Your rate is $44.96. So this is very accurate. Now there's not the APR in here, but we're just showing what a 1.5% interest rate drop would do to a payment. Okay, but it's pretty accurate on what kind of rates were and what they are. So on a $750,000 loan, your total savings in monthly payment would be $750 a month. Now, if you're looking to buy a house, that's a pretty significant monthly savings. For a lot of people, that's a car payment or, a tuition payment of whatnot. So what I try to do here, what Nancy and I were talking about is what does the interest rates really mean for my buying power? And you can see here. So we'll look at the number on the right because that's the savings, total savings. At $500,000, you're saving about $500 a month. At $1 million, you're saving close to $1,000 a month. And that is because of the difference in an interest rate difference between 7.5% and 6%. So when the Feds talk about dropping the rate 50 basis points or 0.5%, if they do that 4 months in a row, which they're not going to do that, but 50 basis points, a quarter, it adds up. Well, now you're looking at a savings on your mortgage of close to, anywhere between $500 and $1,000 a month, depending on what you owe. What Nance, do you want to interject anything that you'd like me to clarify there? Or?
Well, one thing, just a point of reference is this. So these are just strictly your loan, and this is just for the loan exclusively, nothing about your or nothing about your insurance and taxes, anything, correct?
Correct. No mortgage
Straight
insurance,
up.
no homeowner insurance, just
so people
loan and just
understand that.
just hypothetical rates.
Right. I
Yep.
just don't want people to think, oh, okay, it's only
Totally.
3,400 for, yeah.
Totally.
Okay.
And
this is based on a 20, well, yeah. Okay.
Yep. And it's also based on a 30-year fixed mortgage. Sorry. Good call.
Yeah.
That's the standard mortgage. 30-year fixed mortgage is what these payments are on. Okay. So it does, a lot of the people we work with, will call and say, hey, they can afford, $4,000 a month or $3,000 a month. And so we work their purchase price off of that number. So when you call me and say, hey, I want to buy a house, I said, okay, well, what can you afford? You can't tell me $1 million or 500,000. Most people have it, budgeted, in which I suggest budget. What can you afford monthly? And then we work that backwards. Well, if your
Right.
rate's at 7.5%, you can afford a $400,000 house. If the rate's 6%, you can afford a $500,000 house. So it's a big difference.
And one of the things we were talking about before we hopped on, and so that's why I put this in this little font here too, is that in addition to you saving X amount a month on your payment, when your interest rate is lower, the amount that goes to principal every month is higher. Or alternatively, if your interest rate is higher, the amount that goes to, I'm getting confused here.
No, you said it right. The higher the interest rate, the higher amount of your payment is going to interest rate. And kind
Or
of
the lower the interest rate, the higher amount of your payment is going to principal.
principal, which means that you're paying off your loan faster. And you're going to
Correct.
say, what do you mean faster? It's a 30-year fixed mortgage. Correct. But more money is going early to your principal. So let's say, and someone will say, well, I don't care about that. I'm going to sell my house in 10 years. I don't care about to pay it off. Okay. I'm with you. But let's look at our $500,000 example. So the small writing there, at 6%, your payment's lower, but look at your paying principal of $497 a month right at the beginning. Over here at 7.5%, you're paying $371 a month. Okay, well, after, let's say you live in that house and you're in your starter home, you do care what you owe on that house in 5, 7, 10 years, because that's the equity you're going to use to put on your next house. And if you're saving an extra, what is that? Minus 371, an extra $126 a month times 12 months is $1,500 times 10 years. You're going to owe after 10 years about $15,000 to $18,000 less on your home. And that'll give you more buying power for your next purchase.
Right.
And so you're paying down your loan faster. Now, if you made the exact same payment for 30 years, yes, it would take you 360 payments. But after each year, you would owe less with that interest rate reduction.
Right. Okay. What do you had kind of made a reference, and it was just a hypothetical scenario, but you had made a reference to maybe, rates will be cut multiple times this year. Why am I not waiting until the end of the year? If the projection is that there'll be multiple cuts, why am I not waiting until the end of the year?
Well, that's to buy.
To buy or to refinance.
Right. Yeah. So what we hear a lot is, well, I'm going to wait till the end of the year to buy. That's okay. Or I'm going to wait till rates go down to buy. And what I would tell you, and we're not here to push anything or anything like that, but what I would tell you is when the rates go down, there's going to be a lot of people who are going to get back into the market. And it's not that they have been holding out for any reason in particular. They literally couldn't afford it. The payments are rough right now, but look at on that $750,000 loan. So that's called that in Hollister area where we are, savings of $750 a month, right? So the purchase prices did not have to drop one bit. Okay. They stayed the exact same, but rates dropped 1.5%. And now there's an extra $750 a month that can go to a mortgage. Well, if that's the case, we're going to have more people being able to afford to buy. And then we've already dropped. And so if it keeps dropping, then the more and more people are going to buy, we believe that then there's going to be more competition. On a lot of these subdivisions, on the new build subdivisions, the sellers were offering, either 1%, 2%, 3%, up to 4% to help buy down the rate. Well, that's in some cases $25,000, $30,000. Those are going to go away. The builders aren't going to need to do that anymore, or the sellers aren't going to need to do that anymore, because there's going to be 5 or 6 people who can now afford $4,490 who before couldn't afford $5,240.
Right.
And so if I was advising someone and they were looking to buy, I wouldn't tell them to wait. I'd tell them to go look and find the house that they want,
And can
but
afford right now.
and can afford right now. But I don't think it's a good strategy to say, well, I'm going to wait until the rates go down. That way I can get a lower payment. Well, yeah, but then you have more people who can afford it. That's why anyone can afford to go to the dollar store, but it's a lot harder to go to Nordstrom's. It's more expensive. Less people can afford it, and everyone can go to the dollar store.
Right. And I know you and I were also talking about before, Redfin came out with a stat that July had the lowest number of sales of any July in recorded history for the US. And what does that mean? By the way, the prices were not down, but the number of sales were down. So what does that mean? To me, that means that people are waiting, people are holding off, and less activity is happening. And as we see rates, whether they shoot down or trickle down, as we see rates go down, more and more people are going to get back into the game. And we're going to be, potentially in multiple offer situations. And multiple offer situations are still happening in some areas. And in, even within a town itself, in some areas there may be multiple offer situations that still happen. So yeah, I think if you know that you want to buy a house or buy a condo, and you have your finances in order, I don't suspect that prices are going to go down. I don't have a crystal ball, but I don't suspect prices are going to go down. So if you can afford it now, I think it's the time to move. Especially when there is uncertainty like there is now. There's uncertainty with rates, there's uncertainty with politics, all that kind of stuff. A lot of people don't have the intestinal fortitude in times when there is uncertainty to move forward with these big purchases. And if you feel confident about your situation right now and you've run the numbers and you're not overextending yourself, then you might have a competitive advantage over someone else who isn't in that position right now.
Totally, totally, and the cost to build a home is not going down, and the regulations on these builders is not easing up. And so at some point that our supply is not meeting up with our demand, and not even close. And that's going to be, that's to me our biggest issue, which is above a different time for us to talk about, because that is coming down the pipe. If you live in Hollister, you're thinking, what are you talking about? You're building like crazy, but that is not the case basically anywhere else. And we had a moratorium here for 15 years. And so we're almost just catching up, but it's too expensive for these builders to develop the land, buy it, develop it, and then go through the regulation and the years and the risk to make it worth it. And so we do have a shortage of homes, and that's a national problem.
And I'm gonna put you on the spot. We didn't talk about this, but you had I had a client who was interested one time in the past, and you kind of gave me some raw numbers. You're talking about developers, and that's building in bulk. But there are people who say, "Oh, I want to build my own house. I want to buy land and build my own house." And I remember you threw out some numbers, and I was just like, my jaw dropped. I couldn't believe it. So I know that's not your area, but I know you help people, get loans to do that. And I know you've done that yourself. You've built your own house. Is there a price per square foot you could share with me for kind of a baseline house or anything like that, just to give people an idea of, if they were to build their own after having bought the land, what they could expect?
I really couldn't. I mean, any number I say, half the people are going to think I'm full of it. I mean, I don't know, use $250 a square foot or $300 a square foot. It kind of, your permit fees, depending on some houses, we're doing an ADU in San Benito County right now, and our permit fees were $23,000. And our septic tank for an ADU 1 bathroom is $33,000. that's $50,000 for you have a permit and a bathroom. And so it's tough to know. We just have found that when someone calls and we run numbers, the numbers never really work for the person to buy the land and then build the house. Now, if they have the money and that's their dream home and that's what they want to do, like you said, so be it. But from a financial standpoint, at this point, we have not found that to work. And that doesn't include any um, borrowing cost too, because the borrowing cost on a construction and land loan is significantly more than it is on a home.
And that's what I was kind of leading the witness there. That's what I just wanted to people to understand. I mean, not to advise against it, and it's not even my area. I don't know the first thing
Right.
about building. I just know that it's significantly more time, more expense, and then more possibility for something to go wrong, more variables. So if you think like, oh, well, maybe that's an option, I would talk to a builder. I would talk to a lender who's going to lend you that construction loan. I would talk to a realtor who's done land deals and can kind of speak to that because I'd like to say there was maybe some cost savings there, but I don't think so.
Right.
So, well, I think that kind of covers what we wanted to get into today. And if one more thing, if someone does have a what is the kind of rule of thumb if someone, let's say someone does have they bought their house last year, they have a 7.5% rate, from a refinance perspective, what's the kind of rule of thumb that would make it worth it for them to do the expense of refinancing?
Every case is different, but I would say the rule of thumb is that you got to save at least 1%. I mean, that would be my suggestion. Someone might tell you something different. And like I said, every case is different, but a total of 1% would be good. Some people wouldn't mind saving 0.5% if they know they're going to live in that house forever because you're paying off your loan faster, and if you only had the loan for a little amount of time. So it really matters on each person's individual situation. But
Okay.
if we're close to 1% or you're at 3/4, you might want to call somebody and say, hey, I heard rates are down. If I go from 7 to 6.25 and I keep that loan for 3 years, what's that going to do for me? And that's what's one great thing about it, and that's why I love it. It's a total mathematical equation. So you can just show the person the mathematical equation. The only variable is how long you plan on staying in that house or keeping that loan, or what you think rates are going to do. And none of us know what rates are going to do, obviously. So,
And even if you think you're going to stay there in your forever home, sometimes things change with
yep,
that
true,
too. We
true.
learned that too.
Yep,
Well, thanks for giving us the skinny on what to expect. And people know
yep.
that they can reach out to you if they have any lending related questions, and you'll take care of them. So
Yep.
thanks.
Well, thank you very much. Have a great day. Good luck on Saturday.
Thank you. I'll see you
Bye.
then. Bye.
Okay, cool.